Hey everyone, Shaunna Burhop with Beard and Warner. Welcome to the Spotlight Series. Tonight's guest is Ron Haddad. He's a seasoned mortgage and money expert, and we're looking forward to hearing from him answering some of the top questions we've heard from clients. We hope you'll enjoy. I'm Shaunna Burhop from Beard and Warner's Northwest Suburban Office, and I want to welcome you to the second edition of our Spotlight Series. Joining me tonight are my colleagues Megan Barnitz, Mary O'Malley, and Jason Giambarbari. We're all still a little new to the Zoom webinar process, but we're going to try to do our best to monitor your questions and guide you through. We started the Spotlight Series as a way to share some great expertise from professionals within our network. Last session focused on estate planning, and if you missed that one, you can email us to request a link to the recording or find it on our individual websites. This week, we're excited to feature Ron Haddad of Key Mortgage. Ron is a leader in residential mortgage lending with more than 15 years of mortgage banking and home finance planning experience. Ron was acknowledged by the Illinois Mortgage Bankers Association as 2019's #1 loan officer in Illinois. He achieved national recognition among the nation's top 1% loan originators in 2018 and was a finalist for Loan Officer of the Year at Chicago Agent Magazine's 2019 Agent Choice Awards. Ron has continuously received Chicago Magazine's 5-Star Mortgage Professional Award, and he is a regular contributor to mortgage and real estate related news publications. Megan, Mary, Jason, and I realize that the mortgage process can be confusing, especially as there are shifts in the economy or even shifts in your personal life. Policies may change not just daily, but sometimes by the hour. We rely on experts like Ron and others at Key Mortgage to understand the changes and be able to give candid advice to our clients and friends. So we came up with a list of the top 10 questions we were being asked recently and are going to go through those tonight. But we also encourage you to send us questions via the chat box, and we will answer them either during the presentation or at the end during an open Q&A. So now I'm going to turn it over to Ron.
Thanks, Shaunna. Thanks for having me here, everyone. Right now within the real estate and mortgage communities, we are now more focused on the current happenings and occurrences than we had, in my opinion, prior to the now I want to say credit crisis, but the recession. This is all in uncharted territories, and things are changing quite rapidly. But know that Key Mortgage, myself, my team, as well as these excellent local real estate professionals are here to assist in any way that we possibly can and be the experts in these uncharted waters.
All right, great. I'm going to start with the first question. How do trends in the economy typically impact the mortgage markets?
So, trends within the economy, right now it's global. Obviously, it's domestic as well as global. But what happens within the economy is going to dictate the movement of mortgage interest rates and also credit risk. So you've got situations right now with the stock market as well as the bond market, but also the overall economy itself moving forward with what would be considered a recession. That's going to impact mortgage rates, and it's also going to impact the risk that goes with offered credit, meaning different types of loans, the credit worthiness, the down payment amount, and of course the offered interest rate. Does that answer your question, Jason?
Yeah, no, absolutely.
Great.
Hey, Ron, has it become more difficult to get a mortgage or to refinance a mortgage?
Well, thanks, Megan. That's sort of relative just to the time that you're in right now and what you're trying to do. So what has changed is some scrutiny with especially employment. Obviously, during the pandemic, there's a lot of people that are furloughed. There are a lot of people that may have taken a temporary reduction to income, and others just been laid off. Also, too, with that, some credit risk has also been implemented that could impact financing options. So to answer that question directly, yeah, it has become more difficult, but also too, there's been a lot more flexibilities within mortgage lending to allow for this ever-changing market. So it's fluid and it's changing, and even though there can be some obstacles, I do believe that once the dust settles a bit, it could be just a few days, you'll start to see some relief, I guess we could say, of the pressure of what's going on for some of those applicants. Does that answer your question? No, looks like we did.
Excuse me, Ron, we have a
Sure.
question from one of our participants.
Yes.
I've been hearing a lot about loan forbearance, and what is that exactly? And do you think that's a good idea? Part one, and then would it impact my credit?
Mary, that's a great question. That's a great question too. So forbearance is basically a temporary. It's a lifting of the obligation to make a mortgage payment for a period of time. Now, that mortgage payment does need to be paid eventually. That I think is very important to mention. Forbearance is just basically taking the interest in the mortgage payment out of the amortization, meaning the monthly payment period, and then either tacking it on in the end or putting together some type of modification for it to be repaid upon the lifting of the forbearance. It can be absolutely a very good thing for someone who needs it, especially overnight. But it can also be a very expensive, if you're not necessarily aware of what your options are for the repayment of that. It could actually be more, not only expensive, but it could also be more harmful in some cases. The best way to know if that option is for you is to contact the servicer, the bank, or the lender that you're paying your mortgage to learn what the options are, and especially the end game, meaning that if you can put your loan into forbearance for 3 months or 6 months, once that time is elapsed, what happens? What are your options? Not knowing that end game or what your options are at the end could be very, very dangerous.
Ron, that second part, would this impact their credit scores?
So from what I've read with the CARES Act, which is basically the act that's allowing for forbearance to be implemented pretty much on command by a homeowner, it should not be impacting the credit score. But I've also heard that that may not necessarily be the case upon the end of the forbearance, meaning that you may only have a short period of time to either repay the amount of money that was put into forbearance, modify the loan, even if that's an option, or have some type of payment plan. If you can't put that together, or if it's just not necessarily an option, that could impact your credit if you go late. So the answer is that it's a little bit mixed. I think you need to get more information with the servicing lender to find out what your options are. But from what I've read, at face value, it will not impact your credit, but it could later on down the line if you don't necessarily know what that end game is.
Ron, the next question we wanted to consider, I think we've all been hearing from our clients about maybe putting less money down, whether they want to preserve cash for renovations if they're buying something that needs work, maybe just to have some cash on hand, or even maybe when the stock market hopefully starts to come back, they want to start making, future investments. So, is that an option? And if so, how does that work with low down payment loans and all of that?
Shaunna, that's actually a really good question. And everyone's life's changed quite a bit. I had pre-approved customers just 2 or 3 months ago that had been planning on putting down 20 or 30%, and now things have changed and they want to retain some cash just because, right? Just because of what's going on. When I purchased my home 10 plus years ago, I put down 5% to retain cash to go ahead and make renovations on my own pace. I think that's a real good option, especially with interest rates being so low today. Retaining cash and kind of striking when the iron's hot, as my dad would say, with low interest rates. If you're going to borrow money, borrow when it's cheap. Definitely something to consider. As for future investments, I don't want to speculate necessarily, but retaining cash to put money into investments, really, that's how you grow wealth, just like you would with real estate. But also, too, it's just you don't know if now's the time to invest necessarily. But the key is that having that option to borrow at a very low rate at this moment in time is very appealing, and retaining cash in the bank to make improvements or investments is a safe play too. So it's something definitely to consider. Is that helpful?
Yes, thanks, Ron.
Sure.
I had a question on that, Ron, and that is just that we're hearing about that low down payments sometimes are low down payment loans are still not available or whatever. Can you expand on if that's true or if that's not true?
No, there are a lot of first-time buyer programs, even down payment assistance programs. I think it depends upon the lender that you're working with, and I don't really want to necessarily name lenders or banks, but a very large institution just recently required a 20% minimum down payment nationwide. That's not because of necessarily lending as a product nationwide being offered by all lenders. That was that bank's decision based upon their risk. So 3% down, 5% down, of course 10% down is available. There are down payment assistance programs that will allot up to $10,000 in assistance, first-time buyer programs. There's a lot out there. It's just that one would need to discuss options with someone who just has access with those programs.
Okay. My next question is, what is the mortgage and real estate industry doing differently now as we're going through kind of the COVID-19 versus, a month and a half, 2 months ago?
Yeah, so a lot's changed. Quite a bit. We all know that everyone's life's changed. What I think's changed the most is how we all conduct business. I've always seen myself as an advisor. There's a lot of fintech companies out there now, and other real estate related companies where you just sit behind the laptop or your phone and kind of shop for interest rates or shop for properties. Right now, that I think everyone's sitting behind the same laptop. They really want to speak to someone, okay? And they also want to have the ability to ask questions in real time. I think that within my industry and within the real estate industry as a whole, we've now been forced to kind of go a little bit more mobile, where we are available more on obviously platforms like this, video calls, also, processing and underwriting within my company. Just about everybody's at home. Real estate offices now as well. We've got virtual tours and Facebook Live tours. So I think a lot of it has changed within the industry now, how we're really embracing technology. And I think it's a great thing. It's a good thing. But also technology that also comes with that human touch. I think that's what's really changed, is that the accessibility, but also having the human touch aspect with it, even though we're all at home.
Great.
Hey, Ron, is the loan approval process taking longer?
Thanks. It can. Yeah, it can right now. And a lot of it has to do with the third party turn times more so than, I could speak on behalf of me and my company and my team. We're not taking longer, but I do know like larger institutions are taking longer. When you're a nationwide lender, and you've got offices spread across multiple states and different time zones, and they were never set up to be worked from anything other than a call room, there's going to be some issues and pain points. We're not in Key Mortgage experiencing any delays or issues, but also that doesn't necessarily mean the third parties are. So third parties can take longer now just due to access to properties, skeleton crews, even in insurance companies, right? Anything that would have been streamlined in an office could be taking longer, including, the county. It could be zoning. It could be things of that nature. So yes, I guess it could be taking longer, but not necessarily the performance of my team. It'd be, impacted by others' performance first.
Ron, back to that question. I have a question from one of our participants, and they're asking, how long does a pre-approval usually last as far as expiration and so forth?
That's a great question, actually, because that could be changing right now. So it does depend upon the lender. Some lenders are 30 days, others could be as long as 4 months or so. But what is changing, and we've just received some color from Fannie Mae and Freddie Mac, and if you're not familiar with what they are, they're the quasi-governmental institutions. A lot of people seem to be familiar with Sallie Mae for student loans. There's a lot of Mays and Macs and things like that, but they pretty much are the ones that kind of set the rules for others to follow, and then banks and lenders can also implement their own overlays and requirements of how long pre-approvals are good for. Right now, we're good for a few months. It's 3 to 4 months depending upon the program, but in some cases, it could be as little as 1 to 2 months. That could be changing. Like I said, we've gotten this hint that it could be changing based upon how rapidly people's situations are changing. And a lot of people are using credit cards right now, and their credit could be changing. So that's fluid right now. But just know that it's good for at least 30 days, for as long as 4 months. It just depends on what happens next.
Ron, the next thing we want to tackle are, what do you think are the most important factors to secure a good interest rate and favorable terms with your mortgage?
Right. Awareness, of course, of your credit profile comes first. Without that score, that pesky number, you really, that could impact things quite a bit. You need to have pretty good credit. And now you don't need to have perfect credit, because those with not perfect credit scores are getting some phenomenal deals with mortgages and interest rates, such as with the FHA, the VA, or even first-time buyer programs and down payment assistance programs. But the best terms are with a 740 plus credit score, and that would be number one. Number two, know what your affordability looks like. In some cases, your affordability could improve the terms of the financing. So, maybe paying off an additional credit card, something like that, could just maybe improve slightly what your offered interest rate is, or mortgage insurance, especially if you have a down payment less than 20%. And then finally, too, a lot of people think that automatically having 20+% down payment will just yield and result the lowest interest rate. That's not necessarily the case, actually. In some cases, a little bit higher of a loan amount, believe it or not, could yield a lower interest rate. Now, how would you know where that is, where that sweet spot is for, down payment amount? Well, again, you just have to get pre-approved to learn what your options are from a mortgage professional and advisor. So those are, in my opinion, like the top 3 things to just kind of own a little bit and be aware of and monitor to try to capture that lowest and best interest rate.
On that question, we have another question from one of our participants.
Mm-hmm.
When can you lock in an interest rate?
Sure. Well, there are a few answers to that question, but the traditional answer is once you have a contract. Once you have a contract, because the lock is attached to the transaction. It's attached not only to you, but also the address, the price, the loan amount, meaning down payment. Of course, the type of loan. Is it a 30-year fix, a 20-year fix, 15-year fix? Different types of products are out there, but also how long to lock in that interest rate, meaning there's a duration of how long the rate is good for. And then if you go beyond that, it could actually result in a cost to extend. So the traditional answer to that question, and I'm going to answer it that way, is once you have a contract. Now, personally also, there are long-term lock programs available where you can lock in and then shop. It's literally called lock and shop. But in my opinion, those aren't always the best options, but I think it's to each customer's decision of what works for them. But I have to say, really, the majority, more than the majority of my clients will lock once they have the contract, the executed contract in place.
All right, Ron, I get this question a lot, and I think a lot of it specifically because I work a lot with first-time home buyers.
Mm-hmm.
So the top 3 things one can do to maintain or improve credit scores.
Sure, Jason. So first, I think awareness. You always have to be aware of where your credit's at. I don't want to endorse any monitoring service, but there's ones that are for free. There are ones that you pay for. They're not all perfect. They really are not. But still, if the credit score is going up, it's going in the right direction, right? Or if it's maintaining, you know that you're doing something right. If it's going down, it's something to be aware of. But to maintain, I think it's just monitoring, making sure that when you use your credit card debt, your revolving line of credit, that you treat it as best as you can to keep it underneath 33% of the line limit. So if it's a $10,000 line, you don't really want to go above $3,333 per month over month. Try to pay it down as best as you can. But also, too, sometimes just consolidating debt, paying off debt, moving things around for better terms. We've all had those offers before in the mail of, transfer a balance over and pay no interest for a year. It's really just managing it like a fund and monitoring it like a 401k. Think of it as this living, breathing, expanding, or contracting type of asset, and one that you want to manicure and monitor and just take good care of. And if you do that, you'll maintain and improve your credit scores.
Thank you.
Sure.
All right, Ron. For many years, rates followed the 10-year Treasury yield. What is going on now? Where do you see interest rates headed over the next few months and beyond?
Sure. So, mortgage rates, a lot of people think mortgage rates could be set by the Federal Reserve, and they're not. Mortgage rates are pretty much set by Wall Street, and the 10-year Treasury, the bond market basically, is hand in hand for many, many years with mortgage rates and mortgage-backed securities. So right now, what we're seeing is basically the government injecting billions of dollars, which is okay because they did this during the recession as well, into mortgage-backed securities and treasuries, and it's keeping mortgage rates low. And actually, the amount of money that's been injected into this and what will continue is probably going to keep mortgage rates low for a good many years. And I say that with an S, years. Now, where is the bottom of any market? You never know until it's already passed. But in my opinion, I feel that mortgage rates are going to continue at this level, which right now, as of today, we're back to the lowest levels in history. And then if not lower, to break through it. I don't necessarily have a crystal ball, but I would not be shocked at all to see a 30-year fixed mortgage interest rate in the future. Now, when in the future? 6 months, a year, 2 years, I don't know, to be underneath 3%. I wouldn't be shocked to see it. But that doesn't necessarily mean you want to wait for any type of bottom or 2 point something interest rate. The difference of a 0.25% in interest rate for $200,000 loan amount, it's about $24 a month. So again, you add it up over 30 years or 15 years, it's a lot of money. But it should not necessarily swing a decision, in my opinion, of whether you should wait or pull the trigger. I think it's more about the home and more about the total benefit than it is about a single number like an interest rate or an APR.
And I think kind of following up on that in terms of like being able to take advantage of low interest rates, we're starting to hear from people, they've found the perfect home, they want to take advantage of a rate, but they might not be ready to sell. Are there products out there that can help them transition and do that?
Yes. So, that is, interest rates have actually been low for some time. They're just now really getting lower as this market is resulting with products and programs. But that balance, it's tough. It's tough to sell than buy, right? Especially now. So can you buy without having to sell? Yes, there's a lot of products and programs. And that's something that I've been sharing with clients for the last couple of years, at least. Ideally, we understand you want to sell in the morning and buy in the afternoon. But what if that home, falls in your lap that you just can't pass, and you're not, ready or set to sell your home, or you don't have a buyer for your home? Can you do it? And there are options. There's bridge financing, but I have to say that bridge financing right now is becoming a little bit more difficult to secure due to the current market conditions. But if you can buy without having to sell and then sell later on, we can issue recasting of the loan, which basically means you take your proceeds of your home sale 6 months after you buy. Let's say you sell your home, take the proceeds of your home sale, apply it as a principal reduction on your new mortgage, pay a small fee, and you hit the reset button on the loan to start a whole new 30-year term over again at the new balance, lower balance, and the payment will adjust accordingly. It's like refinancing without having to do it. There's also utilization of home equity lines of credit to use that in the same type of structure or similar structure. There's a lot of options to try to have that cake and eat it too. So I think a lot of it just has to do with the pre-approval and understanding not only what your options are, but feeling comfortable with them too. So yes, there are options to consider. It's just about, getting pre-approved.
Ron, I have another question from one of our participants. What is the average time from signing a contract on a home and closing?
Oh, 30 to 40 days seems to be average. That could be right now stretching a little bit, just depending upon people's, situations of, getting movers and packing and things like that. It's obviously a different environment for the last 60 days or so. But right now, I'd say 30 to 40 days. It does depend upon the market. A couple of years ago, everybody wanted to close in 20 days, and then 5 years ago, everybody wanted to close in 60 days. I think it's just a trend within the market. But 30 to 40 days seems to be the norm right now.
And then, Ron, what if the interest rate changes during that time?
Mm-hmm. Oh, within the lock. So
right.
There's always a strategy. I never rush to tell a customer, now's the time to lock in. I'll always provide my suggestion. It's the customer, the client, the buyer's ultimate decision. Again, there's no crystal ball, but right now for the last 3 weeks, we've been in improving market conditions. And if we can monitor interest rates and pick up a lower rate, by locking it in a week or two later, that's a win for the client. There are situations where we can lock in the loan and then issue what's called a float down arrangement, but there has to be certain criteria to be hit and reached in order for that to kick into place. And sometimes it's tough to do because the rates are so low, right? I remember my mentor years ago saying, if the rate goes down, you want me to move it down, but if the rate goes up after I lock it in, can I move that higher? Of course the answer is no. The integrity of the lock is an important thing with Fannie Mae and Freddie Mac and banks and lenders, but there are still strategies available and also options to consider. If those options are best for you, like the float down, we can explore that and possibly some other strategies too.
Okay, I think the old adage of when people thought it'd be a good idea to refinance is like when there's a point savings, but I always think it's important to ask a professional, what are the most important factors when deciding whether it makes sense to refinance their current mortgage. So I know as these rates go lower, obviously you guys get busier with not only origination, but also refinancing. You can I know it's a hard question to ask because there's a lot to it, but if you can kind of give some little factors for everybody, it would help.
Well, I think everyone sees value in a different light. For me, I think it's more of a time and cost comparison with the value, meaning that if you could save $100 a month, a lot of times it's a no-brainer, all right? But it only makes sense if you plan on staying in the home for at least a couple of years, Because to refinance, there are costs involved. There are, an appraisal in some cases, a title company charge. You've heard, a lot of times we've all heard about these no-cost refinances. Really all that is an increased interest rate 9 out of 10 times. So instead of offering you a lower rate with some costs, the interest rates usually increase to cover the costs. What would you rather have? But in most cases, you're going to have some costs. And if you can recoup or recapture those costs inside a couple of years, and you plan on living in the home for at least 3 years, you should definitely consider it. And there's no cost usually no cost, at least not with me, to explore and learn what your options are for refinancing. The numbers make sense and it fits what your goals are, then, a lot of times customers will do it. If not, we've explored it, those options, and just know that they're there. But there's never any obligation just to learn what the options are. So that's probably the best answer. It's the time, the savings, and the costs. You put them all together and bake it into a cake. And if it works, it makes sense, then you'll move forward. If not, then there's no cost or obligation. Does that answer your question?
Yeah, absolutely.
All right.
All right, Ron, that seems to be the last of our questions. I always find you such an interesting financial brain. Do you have any final thoughts for us in this whole thing?
Yeah, so, we've been hearing a lot about shop local, especially now. There's just so much going on, but within real estate, absolutely within real estate and mortgage lending, now more than ever, should buyers and sellers be working with the local professionals, the regional game changers with it, meaning that, again, I work for a local mortgage lender. We focus on the greater Chicagoland area. All of you guys, everyone on this panel works for a company that's focused on the greater Chicagoland area. We are not influenced or impacted by what's going on in New York or California or Florida. It's of course a national thing that's going on right now, but working with those that are local and the advisors that are focused on our area and community is the best thing when buying and selling real estate right now. So my parting and takeaway from this for anyone that's participating in this is now more than ever do you need to have a local professional on your side, on your team, and they having on their team the local professionals as well is crucial. So that's my takeaway with this, and I want to thank everyone for having me. Thank you for including me on your spotlight session.
Well, thank you, Ron, so much. On behalf of Jason, Mary, Megan, Shaunna, and Ron, we do thank you all for joining our webinar today, and we hope you enjoyed it. Feel free to send us feedback or any other questions or topics you'd like us to address. I think we see this for the long haul, even after we're able to come out of our cocoons. So thanks all for everything. Thank you, Ron. And that concludes our webinar.
Thanks so much for having me.